quarters, and the earnings will be hit, of course, in the meantime. But again, looking at the medium term, what the market is telling us is that next year could be actually not as bad as we feared a few weeks ago.
Is that also, Frederick, do you think, reflected in the action that's been going on in Europe? The ECB, various European nations, again, very much putting their foot on the accelerator as far as interventions of various kinds are concerned. But is it enough?
No, the short answer is no. The ECB has provided the necessary backstop and circuit breaker, I would say, for this crisis not to turn into a financial crisis and something much, much worse. So that was necessary. It's not sufficient for the recovery to build from here. And by the way, it's not the ECB's mandate to fix the economy over the longer term or the public finances for that matter. It's the job of the government. And what the market in Europe is telling us in that case is that it's not enough. I think the key point here, looking at the price action in Italian BTPs, for instance, over the past couple of sessions, is that who's going to pay the price? It's not an appropriate answer, way to put the question, I think, but still what the market is pricing in is the medium-term outlook for Italian debt, which is likely to remain on the Italian balance sheet for now, unless we get some sort of policy decision and some sort of debt mutualization in the future.
Yeah, Frederic, you've had Ray Dalio on the one hand say you'd be crazy to buy government bonds, whereas BlackRock and a number of other big investors have been saying buy what the Fed's buying: treasuries, investment-grade debt, fallen angels, bond ETFs. Are investors in Europe of the same mindset that you should be buying what the ECB's buying?
I think in credit market in particular, the ECB has a longer experience compared with the Fed in buying corporate credit. They've moved down the credit spectrum. They could even buy, perhaps in the future, high-yield debt under some very strict conditions. But still, we have this experience, and market participants have been adjusting to this. So yes, I think in euro credit, it's a safer place overall in our view than in some other areas of the U.S. market. Having said that, of course, the recent Fed decision is a game changer as well. In terms of government bonds, obviously we are talking about different things from Germany to Italy. But here again, I think the ECB's message, whatever happens on the political side, is strong enough. They will not allow any financial fragmentation that would prevent the recovery from building from here, and that would actually weigh on the inflation outlook over the medium term. So there might be volatility. There is currently as we speak, but I think again the ECB's message is strong enough to support this market as well.
But Frederick, moving from bonds to equities, where are the sectors that show most resilience that could come back? I mean, many people are surprised, I think, by EasyJet this morning saying they don't need, they've got enough cash to last in effect for 9 months. But I mean, in general, I imagine the travel sector is one of the worst hit.
It's, there are so many idiosyncratic risks at the moment with the threats of bailouts, maybe some consolidation, mergers and acquisition in other sectors. What we see is really something that still favors quality balance sheet. So it's not so much in terms of sectors, especially in Europe, where, as you know, the weight of the tech sector is much lower than in the US. But we would tend to look at companies on an individual basis and looking at the balance sheet and the quality and the indebtedness and this kind of metrics that really favor, again, defensive names and sectors also overall.
Frederic, are you on board with some analysts and investors out there? I mean, Standard Bank is one of them, saying sterling's going to strengthen to 80 pence per euro. Obviously, it's not been there since the 2016 Brexit vote, possibly beyond, because they say the pandemic means the deadline for a trade deal with the EU this year could be either pushed back, delaying the risk for the pound, or see more favourable terms given to the UK. Would you want to be adding pound exposure either against the dollar or the euro right now?
Longer term, we still see a risk that the big issues with between the UK and the EU have not been addressed, and as a matter of fact, it's not the top priority right now. Short term, yes, maybe, because, there could be upside from time to time, because the policy response in the UK some extent has been more flexible, more targeted. Direct, explicit monetary financing is not possible with the ECB. That's what the Bank of England decided. Fiscal stimulus could be ramped up. Yes, there might be some reasons to be relatively more optimistic over the short term at least, but that's not something we would see over the medium term. It would tend to fade any strength in the sterling from these levels.
All right, Frederick, thank you so much for being with us. Frederick Ducrozet there, strategist at Pictet Wealth Management, joining us down the line from Geneva. Many thanks for being with us. Coming up, Matt Miller and Caroline Hepker in a takeover Daybreak Europe, and they'll be speaking to Paul Brain, head of fixed income at Newton Investment Management. Nera, we were talking about green on the screen earlier. We're now almost an hour into the European opening. How is it looking?
Still green, Roger. The Stock 600 up more than 1%, 1.1%. Looking across regional equity benchmarks, you've got the FTSE 100 lagging a bit, up 0.4%. The FTSE MIB leading, on the other hand, up more than 2%. IBEX, DAX and CAC 40 all up more than 1%. We saw some weakness in US equities yesterday following that painful data, retail sales and factory output, and some April surveys. Futures in the green, S&P E-minis up 0.8%. The 10-year yield edges up 2 basis points. This is Bloomberg.
Are you looking for senior care for your mom?
Hit the court anytime with these great NBA podcasts on TuneIn. The Low Post.
So what struck you about this potential head-to-head matchup? What did we learn now that Zion is involved and LeBron and Zion go at each other for the first time? You know, I still think both teams have to figure out kind of who are their guys when they get into a fourth quarter. I think you saw that with both of them. There were some kind of odd moments.
The Ringer NBA Show.
Who ended up winning the thing. But I did watch for a little bit when it was DeAndre Ayton and Zach LaVine playing against each other. And then as the days went on, Devin Booker was involved. Tell me you've seen the clip of Devin Booker when I can't remember who his opponent was.
Or the Haber Show.
At the end, it's because I worked in the NBA in the front office, and when I was 14 years old, my family moved back from Sudan to America. I went up high school here in New York
Find these and more NBA podcasts right here on TuneIn. Get your MLB fix with these great podcasts on TuneIn. Fill your seventh inning stretch with the Ringer MLB Show.
I just can't get over it. It's like, Jeter Downs. Didn't realize he was a top. Like, my dad is drinking the Kool-Aid on this. He's like, of course. Mookie was going to leave. I'm like, what do you mean? You don't know that.
Slide into second with the Starting Nine podcast.
Nolan Arenado slides right into the top spot for a favorite baseball player. Active in the league right now. It is a pleasure to be sitting next to you, sir.
Thank you, man. I appreciate it. Thank you.
This is we've been waiting a long time for this. We actually, in terms of like active
Round the Bases with the Statcast podcast.
Ways of going about it. I picked third, so in some ways it made it easier for me. Mike, just to go over the first couple of picks, Mike took Barry Bonds, who I think was kind of the obvious guy to take number one, not only.
Catch these and more MLB podcasts right here on TuneIn.
The world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio.
This is Bloomberg Daybreak Europe.
External pressure is going to be an opportunity for reform in China. I think liquidity more generally across financial markets is an issue and a concern. The Spanish banks in particular are in a much better place than they were 5 years ago.
It wouldn't be great to have a drawn-out trade conflict with the US or indeed with anybody else. I've never been one to prophesy where sterling will be, and you're a madman if you think you can.
Bloomberg Daybreak Europe on Bloomberg Radio.
All right, good morning from London. I'm Caroline Hepker.
And good morning from Bloomberg's Bureau in Berlin. I'm Matt Miller. You're listening to Daybreak Europe on London DAB Digital Radio.
So the markets this morning in Europe, we gain on the Euro Stock 600, Matt, up by 1.1%. The FTSE 100, though, is the laggard, only gaining 0.3% versus Germany's Xetra DAX up by 1.2%. Interestingly, the Italian FTSE MIB, though, is the outperformer. We gained 2.3%. This as the debate in Europe heats up around the lockdown, how to unwind it. Calls for a united approach from the EU, but it does seem as if countries are doing slightly different things, probably because they're facing different coronavirus pandemics.
Yeah, for sure. We also tend to play kind of leapfrog and catch up sometimes with other markets. So In Europe, we had a drop of more than 3% yesterday in the cash trade, and the U.S. was down only 1%. So it looks like to some extent European indexes are playing catch up a little bit to the U.S., although you do see U.S. futures gaining as well today. So the question is how this is all going to shake out. Let's get over right now to our guest in the studio. Paul Brain joins us from Newton Investment Management. He's the head of fixed income there. And Paul, let's start with what you've witnessed so far. I mean, in your career, you say there are similarities to what you're seeing now with what you saw during the 2008 financial crisis. How is that playing out, and how are you positioning your portfolio to stay alive through this?
Yeah, good morning, everyone. Well, there are similarities. Of course, each crisis is different, and certainly this crisis is completely different from the financial crisis in many respects. Similarities are, of course, you've got very poor liquidity conditions initially. You have some dysfunctional markets, mispricing perhaps in some of the fixed income markets. And then you have central banks, and you have the authorities stepping in to calm the waters a little bit and then fix some of that liquidity problem. And that's slowly coming back to normal conditions. This time around, of course, we're seeing much more and faster fiscal stimulus, fiscal intervention. We're seeing, of course, the drop in interest rates happen very rapidly down to very low levels. And we're seeing much more, much faster QE-type programs coming through. The response from the authorities, I think, is faster this time around because, of course, we've been through this in recent past with the financial crisis, these liquidity conditions. So they know what to do and how to do it. So they're having to do it in much bigger size because we came from a low interest rate position in the first place. So they're having to do a lot more QE. And on the fiscal side, of course, the fiscal plan, the support for the economy is unprecedented compared to where we were in the financial crisis.
What do you make of the debate that is being had in Europe, Italy, whether or not to use the ESM? So the Italian Premier Giuseppe Conte saying that it needs to be approved before they'll think about it. But Italian yields, meanwhile, are moving, obviously because we don't have Corona bonds, no agreement on that. 1.79 is the yield for Italian BTPs on the 10-year. So we dropped 9 basis points. That's another big move for Italian BTPs today.
Yeah, they're bouncing around quite a bit, aren't they? Because obviously we've had a few days of yields rising in Italy, spread widening against Germany on a belief that they won't use the ESM, that they're going to have fights and try and get the recovery fund up and running, and a recovery fund that is jointly funded by all governments, so effectively a joint bond. So maybe we're seeing a bit of relief from that. We're seeing perhaps some support for Italy because of the number of cases and the number of deaths slowly having passed the peak, declining. I think I don't think we're out of the woods. I think we'll see more of this. The political debate between the periphery and between Italy and the core is going to continue. And until we get a joint bond, I think we will always have a widespread between Italy and the core countries in Germany.
Is that going to happen, Paul? Do you think that's because here in Berlin, from this vantage point, it doesn't seem like that's at all a possibility. Certainly not when I talk to politicians.
No, I don't think it will happen this time around. I think they believe that the ECB with its PP program and the deviation from the capital fee structure, I think they've done enough, perhaps, in this crisis to stabilise spread. You know, when I say a wide spread, I'm not suggesting we go up to 300-400 basis points here. I'm just thinking a spread above or around 200 over Germany is probably correct, whilst you have such poor or big deviation between the finances of Italy and the finances of Germany. I think it doesn't help in some respects that the Northern European economies seem to be faring better through this virus crisis than the Southern European economies. And that's not going to engender a group discussion about a group bond or group funded bonds. So I think we're not going to see it this time around. We probably need to see further economic pain for the North before we see the need to get a joint coronavirus bond out there.
Can I just get your take quickly, Paul? I mean, the Germans would say, yeah, well, we were prepared for this kind of thing. You know, that's why we weren't running budget deficits. This is the reason that we put austerity into place, and may even accuse the periphery of being a little bit fiscally irresponsible. On the other hand, Joe Stiglitz says that it's precisely because they've joined the euro, because they don't have the ability to devalue their own currency, that Italy, which is a huge economy, ended up in this position. What do you think?
Yeah, that's the perennial debate, isn't it? I think you're correct to identify that. I mean, you could argue that Germany has a lot of customers in Southern Europe because of the higher spending capacity in Southern Europe compared to Northern Europe. It's the reason why it has a current account surplus and the rest of the current account deficit. I think they are symbiotic. I think you can't have one without the other within the European construct. So I think that debate will go on, and I think you're not going to change the spending patterns. You're not going to change the financing patterns of Italy by punishing them with much higher borrowing costs. So that lesson has to be learned as well. So I don't. That's why I don't think we're going to see a joint bond, because I think there are many people in Northern Europe and particularly in Germany who would say it would be rewarding them for their past digression.
Interesting. Yes, that is certainly one perspective. Look, how do you think that...
It's like the perspective here,
yes.
I'd say.
Yeah. How do you think that Europe is faring right now in terms of, this week has kind of been dominated by all of these video conference calls and the fact that Europe has not really come up with this unified response. Have you got much hope that will happen as we now think about unwinding the lockdown? Because that's really kind of one of the themes, although it's a very kind of cautious unwinding, isn't it?
Yeah, I think it probably has to be, doesn't it? Because there's a great chance that the virus sticks around with us for a long period. I think in 6 months' time, or maybe even 12 months' time, once we're through this, I think Europe will still be left with a greater chance of having low inflation, maybe potentially deflation, because of their slow approach to the economic shock, should we call it that, as compared